I'll get to the focus. So best value now is relative terms. So what best value says? Best value says that you're focused on cost minimization and you want to have the lowest cost, but the best value is in relation to your competitors, right? So the first one, cost leadership low cost, is absolute lowest cost you can get to when you look at your operations. But cost leadership best value would be relative to your competitors. So when you do your strategic cost analysis, you realize your competitor in particular critical activities in the business or units in the business, this is where their costs are. You try just to be below that. So you have the best value for money compared to competitors. If the competitors' cost structure go up, you just come in below them. So it's always relative to competitors. But the first one, low cost, is absolute. You're just trying to keep your cost down to the minimum where you don't lose your quality and where you're still able then not to sacrifice quality for price and you're able to remain competitive. So remember, the bottom line, folks, of all we're talking about here with these strategies is to gain a competitive advantage, right? That's the whole thinking of Porter. Now, with the focus low cost, what is the focus strategy, Lisa? Yeah, another name for focus strategy. Focus is a niche strategy. Porter calls it focus, but it's really a niche strategy, right? So it's really a select market that you have, not the broad-based mass market. This is a select market for a particular demographic group, like a niche where there's a particular group that has particular needs that you want to service these particular needs. Right? And we know the thing about a niche strategy is that there's not going to be massive competition, but you're able to provide this particular product or service of value to this particular deserving or desiring demographic group, whatever that demographic group might desire, right? So you could have, if you look at jewelry, you could have a jewelry store that sells to the mass market. So Lisa, what kind of jewelry store will sell to the mass market? Which could deal with cost leadership, low cost and best value. But what would they sell? Yeah. Correct, right. Gold plated, correct, right. So they will sell a lot of simulated stuff, gold plated, or low carat gold, not no high quality gold, no real style, just the basic fringes. You buy a gold chain, it's just a basic chain, not necessarily any jewels or anything like that. So that's why, so you focus on the cost leadership strategy because it's really a cheap product. And so many people can set up that because barriers to entry, would barriers to entry be high for that, Rory? No, barriers to entry going to be low. But for focus strategy now, what kind of business would be into focus strategy for jewelry in the Caribbean? Give me some names. Right, Diamonds International, right, yes. Right. So you will find out for a focus strategy then, Rory, is where somebody determines I'm going to send some high-end stuff, high value, high cost, but as I said, it is not cheap. So low cost doesn't mean cheap. All it means you're trying to keep your costs down. So even in the niche, the same with a focus strategy, in a particular niche, the company tries to keep its costs down to the minimum with one simple objective, to maximize its profit. But in the second one, best value, you're focusing on quality. Quality is still the essential element, that it is a niche strategy, but the highest quality is what you're talking about. So the best value strategy would be you want to have the best cost structure relative to your competitors, and quality is ultimately the superior thing that you're looking for. Right? Now, so the thing about a focus strategy or niche strategy is that when there's high brand loyalty or commitment, what are the patterns, the buyer's patterns? When there's high brand loyalty or brand commitment, what kind of patterns of behavior you're likely to find with customers who buy? What do you think, Rory? When there's high brand loyalty or commitment, what kind of buying habits you would find with those customers who they buy often? What else? What about price then? How would they respond? But how would they respond to price changes? Would price changes affect their buying habits? No, it doesn't, right? Correct. But once in the niche, you would find that, right? That depending on prices shifting, people still buy. Right? Because when you buy brand, you're concerned more with the value or the perceived value you would get for the particular product and the fact that it's a selective brand that you choose. So you generally would not find people, I think the price, elasticity of demand, where as prices move up or down, the buyers' habits don't change. Right? So that would, what is differentiation? What's the differentiation strategy? Anybody can give me an example?
When you try to make something about your brand sufficiently unique that
So the best way to put it, how would Samsung differentiate a Samsung 6? How would they differentiate the Samsung 6 range? Is there just one phone called a Samsung 6, or are there different types of Samsung? Are there different models? Right. So what about cars? Is there one Toyota Corolla? So you have the Corolla, Corolla GL, Corolla GLX, Corolla GLI, Corolla GT, Corolla Turbo. Right. Same Corolla. So what happens in differentiation? It is adding unique or special features to the basic product. So that's really, you have the iPhone 7, iPhone 7s, iPhone 7 Plus, 7s Plus. That is what you call differentiation. The same basic product. And then how else would you differentiate a phone? You worry what else can somebody differentiate a phone? Memory. Right? 8 gigs, 16 gigs, 32 gigs, 64 gigs, 128 gigs. That's differentiation. So when you have cars and differentiated, so what kind of things would a company do to differentiate a car physically? Right? Acceleration, two-wheel drive, four-wheel drive. Some got wheel caps. Others would have rims. Some have the leatherette seats, higher grade. Same Toyota Corolla. So one called the GL. It has plastic seats or leatherette. The GLX now has leather seats. So the radio in the GL, just a basic radio. The GLX now has a radio with a nice stereo sound. The GL, it has no Bluetooth. GLX, Bluetooth. Same, but it's the same basic car. So differentiation is just adding unique features to have a perceived additional value. And as a result of that, you could actually charge different prices. And that's what companies do. Right? So it can happen to a whole set of things. Bikes, basic bikes, and you add some additional feature to get people to buy. Right? As I said, jewelry, watches, same Seiko or Rolex, but one has, you can put diamonds, they put jewels, same basic phone, right? But they add features. So the other thing we notice here, if you look at the matrix, it is saying basically then that for type 1 and 2, for very large markets, and that's what we say, mass markets, very large, right? And And you can see then for the focus strategy, you can see it's for small markets, which is what the niche is. And the large, when we say large markets, what kind of conditions would exist in large markets, Daniel? A lot of competition, right? Right. And what would allow this competition to be plentiful? This way of five forces model will help you. What would cause competition to be so plentiful? Low barriers to entry, right? You see, because there are low barriers, so sometimes you can integrate like a five forces to try to understand these models. So if there are low barriers to entry, it means that startup costs are low. You don't have a lot of money to start up the business. Hence, people with basic capital can enter the market. Whereas in a niche, the startup cost might be substantially high, so you really can't afford to enter the market, even if you wanted to. So like with jewelry and diamonds, and particular brands of clothes, you really can't afford to buy the stock. So you really can't have establish that niche market. So you can make note of that. So this is just some explanations of it. And you see the point I was making there, Rory? Number two. Or number one, to perform value chain activities more efficiently than rivals and control factors that drive costs, right? So the other term that you would find happening a lot is issues of cost drivers. And tech should have a range of cost drivers, which could be economies of scale or scope, you know, under capacity utilization, right? So so it's saying here more efficiently than rivals and control factors that drive your costs and revamp the firm's overall value chain to eliminate cost producing activities. And this is the point I was making here about doing your strategic cost analysis to identify where a competitor might have a higher cost structure or lower cost structure than you might have. Right? So I would suggest to you, even in preparing for the exam, spend some time reading up the notes I put up on value chain analysis, because you will get something in the exam related to value chain analysis. You just need to know how it works. Right, and then you have, right. So you see rivals products are identical. So this is a very perfect competition, right? So it's like when you go overseas, um, you go in stores and here's somebody 1995, somebody 1990, another person 1988, another 1942. So why do you think people are having that kind of margins, Stanley? Why people are having these kind of margins? What kind of conditions would exist for people to have that kind of pricing structure? With these saints, 1998, 1995, 1990. Lisa, what do you think? What kind of business conditions would exist for people to have that kind of pricing structure? And the answer lies in accounting. When the margins are very close, when margins of profitability are break even. You know, if your profit margins are very narrow, then you know, your margins are very narrow, 5%, 8%. What's the ways in which you can make profit, Lisa? When your margins are very narrow, you have no big profit margins. What you got? What would allow you to be profitable? What do you mean by volume? Not mass production. You got to sell plenty products, right? You have to. Your sales numbers got to be huge, right? Not necessarily mass. Well, mass production could work too, but the main thing you have to have a lot of sales, because when those margins are narrow, the only way you're going to be making reasonable profit is that you keep your costs down and try to sell as many products as possible, right? So volume. So they depend on volume. A lot of people coming in. So with the volume, they're able to generate in any one month lots of revenues. But that means that their cost management strategy has got to be very, very good. So say compared to its rivals. So the point we are making, this term that we hear a lot, value for money. So it is where customers perceive value for money that is the important thing. Huh? So as we said, by having a powerful cost leadership strategy, you're able to offer your customers better prices. You understand what we're saying? You understand, Tanya? Because I am keeping my costs down to a minimum, I am able to offer customers better prices. And the more I keep my costs down, the more I can offer better prices because my profitability can be more assured. But if my costs are high, I can't really offer customers best prices because you understand my costs are already high, and because the costs are high, if I push up my prices too high, and there are a lot of competitors, what would the customers do? They go to somebody else to buy. Right? So in that mass market where there's a lot of competition, where people have choices, there's very little you can do to establish high prices in the market. And as we said, then you see more special features are hard to imitate by competitors and different demographics. So people got in different tastes, different riches, you know. So people with the bigger screen for the phone, like the iPhone Plus, is that they might want a bigger screen to see better, or they might just prefer a bigger phone. So people have their different preferences, or they might want to use it for different activities, maybe watching movies. So hence they want the bigger screen. You see. You all remember when they had the iPod. So years ago, you would see the little children with the little iPods watching movies, and you say, "Well, how they can watch a movie in that little thing?" But it's a regular thing now. People watching all kind of movies, you know, using the iPods. So you see, the second point, the pace of technological change is fast, and competition revolves changes. So that is where we said a lot of the changes we're talking about could be significant, but could be just basic technological innovations, you know. So I add some bumpers, so sometimes you see they add a different bumper. You understand? So you have the GL with one black flat back bumper. The GLX has some no nickel bumper, different style. One might have a little spoiler. So it's just little technological innovations in the mass market. If it was now in the niche market, you can have maybe much more sophisticated, you know, innovations. As you say, catering to particular demographics groups. And that's what the niche strategy would be. And I'm stressing that in a niche, you're looking at costs, relative costs, and not necessarily cheap products. Right? So even for companies that have very expensive products, they still need to manage costs. So that will be 5 generic strategies. And for the others that come, what I said I want you all to do when I finish this shortly is to the papers I give you, I want you to be able to get together and discuss, look at Flow and look at Digicel. And then based on these strategies we are touching on here today, I want you to identify for Flow and Digicel which of these competitive or corporate strategies do you think Flow and Digicel are using? Are they using similar strategies or are they using different strategies? So everybody should, do people know what forward backward integration are? Dan, you know what they are? What's forward integration? Do you see, you can remember? Is what? To do what? but not value chain, essential to what? It is at the inbound logistics stage. So they apply companies that are, if it is at inbound logistics, what are they acquiring? The support, not even the suppliers, right? So you're gaining control of your suppliers or major supplier so that you can control the price that is paid for the suppliers. Right? So that's backward integration. My sources of supply, Rory, are unreasonable prices. So I get a hostile takeover. I give them an offer they can't refuse, and I take control of the supply sources because this particular supply you give me is critical to my production, and you have been unreliable or your quality has been inconsistent, and it's costing me money. You see what we're saying here, Tanya? In other words, if my supplier is unreliable for a critical component for my production processes, you're going to offset my production cycle, and it could cost me a lot of money. So it's better for me to either engage in a strategic relationship with you or buy you out and take control to upgrade for more consistency. Forward integration then would be what? Take control of your distribution channels. Right? So when you forward integrate, you take control of your distribution channels. When you horizontally integrate, what do? Right, you take over a competitor. Right? And you're trying to eliminate competitive pressures and also benefit from whatever unique capabilities or capacities they might have. So we have it here, just the terms that gain control over forward integration, gain control over the distributors, backward ownership and control of competitors. And these strategies, familiar with these, what, as David called them, intensive strategies. What is market penetration? How does it differ, Tanya, from market development? So it deals with market share. So in market penetration, I'm trying to extend and capture market share. So if I were in Antigua, you have any fast food? You have Kentucky and Antigua, right? So, huh? Plenty, right? So in market penetration, it means that most of the Kentucky branches are in the west and the south of Antigua, and an entrepreneur realizes maybe we need to open a branch in the north. So it's like what your Fed is doing. You're in St. Michael, then you move to St. James, then you move to St. Michael, sorry, Church, you move to St. Philip. So penetration is where you're extending your market reach in your country of origin. That's penetration. So you're just penetrating an existing market. Market development is what then? If penetration is extending your market share or reach in your country of origin, what do you think that is market development? Correct. So that developing a new market. I realized that in Antigua, that I am into the business of selling clothes, high-end clothes for ladies going to formal functions. But I realized in Antigua, everybody is doing it now. My profitability is falling, my sales are falling, my market share is falling. Too many people are coming in because barriers to entry are not very high. So Antigua, Rory determines, I think I need to move out of Antigua. So Rory goes to St. Kitts, he scopes the market and he realizes there's nobody offering such a product in St. Kitts. So he does his research, environmental assessment, country risk assessment, and Rory then seeks to get through the legal process, register and establish a business in St. Kitts. That's what we call market development. And the whole thing is, in some market where the market is challenged, the market is really becoming mature, some people move out to try to extend market share. Product development speaks for itself. So you say penetration, greater marketing effort, spreads up markets, market development, and new geographical so forth. A lot of students get this mixed up. Remember, market penetration is in your existing home market. Market development is in a new geographical area that is not part of your home market. So you're creating new markets, as it says here. Product development. So let me ask a question. What kind of organizational conditions will lead to product development? What kind of organizational conditions would lead to product development?
The market is already saturated, or you've already achieved.
But hear what they said, organizational conditions, not market conditions, organizational conditions. Not necessarily. You can have the same vision. But we're talking about product development here. Hmm?
Declining profits.
Yeah. But what is involved in product development? Right? Here it said improving present products and services and developing new products. Right? Research and development. A culture of innovation, creativity. That's the only way you're going to be able to develop your products. So if you don't have anybody in your company involved in research and development, bringing innovations and creativity to the table, there's nothing that can innovate. So you need to have that culture. So we're basically saying here, product development can only exist, Tanya, in a culture that facilitates creativity and innovation. People developing new ideas. You need to be sensitive to that. Right? So we've gone through the integration strategies, right? The intensive strategies, which will be market penetration, developing markets at home or extending markets at home, market development, creating new markets, and product development, you're innovating and bringing new products or adding features to new products. And diversification. The other type will be diversification strategies. So what do diversification strategies do? You have related and unrelated diversification. So if I have a car I make cars. If I want to get into related diversification, what would I begin to do if I make cars? What is related diversification? Sorry? Car parts, that's it. Because right now in making cars, I might not make the engine, but I might set up a company to make engine or car parts. I might get a company now that supplies the car parts. Correct, Rory. So what then would be unrelated diversification? Or tires, Rory. I can get into making tires. Right? Tires are still related to the cars. What is unrelated?
Real estate.
Yeah, real estate. I set up a beauty salon. I buy a hotel. I buy a jewelry store. So a lot of the big mega companies, the Macy's and the Macal in the Caribbean, a lot of those companies actually have a lot of unrelated diversification. So they're in supermarkets, they're in pharmacy, they're in restaurants, some got hotels, they sell cars, they sell furniture. Um, so that's what unrelated diversification is. Something that is nowhere related to the value chain processes. That's the best way to distinguish it, Tanya. That if it is related diversification, it has to be linked in some way to the value chain activities of the existing product. Unrelated is I go into an area that is I have no kind of competence, or my value chain activities are in no way related to the the existing product and the processes involved in the existing product. So a top restaurant that is into fine dining, opening a fast food chain, that's related diversification. A drink company, a company that sells um, sweet drinks, right? Going into soy milk, related or unrelated? Daniel, a company that sells sweet drinks goes into selling soy milk, related or unrelated? Sorry? You say unrelated? You agree, Rory?
It's related.
Why? Sorry? But why? Not because it's a drink? Yeah.
We share some of the same value chain.
Correct, yeah. The value chain activity, in other words, the process of filling bottles with liquid. Right? So the companies, remember they said the value chain activities are similar where you have competencies in the value chain activities. So the production process of filling bottles, whether it is soy milk or almond milk or sweet drink, I still have competencies and I can, to adjust my production processes to accommodate soy milk, do you think it would take a lot? No, it wouldn't. Because I already have bottling capabilities. I'm just using a different type of product inside the bottles. So it is related. So a soft drink and soy milk company going into selling cough syrup. Related or unrelated? Cough syrup. What do you think, Lisa? Yeah, I agree. Yeah, there's some competencies you might share, but the thing about pharmaceuticals now is regulatory control, regulatory processes and approvals, and the issue now of safety, right? Which is the safety issue now. You need to have competencies now with food and drug administration. Even the medication itself requires a particular medical competence, right? So even though there's something close in terms of a production process, the core things that are required in producing the cough syrup is not necessarily bottling. It is actually the cough syrup itself and all the regulatory conditions that are associated with it. So you will have to get a whole new set of competencies in the pharmaceutical area, which is not, and it's very regulated. Whereas the soft drink industry or soy milk is not as regulated. But in this one, you have to gather a whole set of legal competencies, which could be very costly. So I agree it would be unrelated. It is close but unrelated. Because the core, maybe the thing to say the core competencies are really totally different in making a sweet drink. Because soy milk, basic product, you can put sugar or non-sugar. And the key thing would be the value chain activities. All right, there are a couple of levels defensive. Maybe you can look at these ones, yes. We look at these ones last set and then we look at this working case. So retrenchment, reduce HR. One of the things you would need to know, folks, because sometimes they give these things in the exam, how divestiture differs from liquidation, right? So when I divest, I sell off a part of my business. When I liquidate, I shut down everything. In fact, you all heard that Toys R Us dying. And years ago, I remember back in the 90s traveling to the US and my children who were young children at that time, you can't go to the US unless they're going to Toys R Us and says on the You can't come out. And they say they're on the brink of really shutting down that it's just billions of dollars in debt. So they say that likely in the next coming weeks, it's actually just going to close down.
It's already happening.
It's already happening. Yeah. So they're liquidating the company, shutting it down. So don't get divestiture and liquidation mixed up. All right, Tanya? I'm Lisa. Creating entry barriers, lowering costs of high demand products. So you create entry barriers to prevent competition, right? So if I know I dominate in the market, I find all kind of ways to prevent people from coming in. It can be fair and unfair. So if you have a good relationship with, I remember, in fact, a good case of that, Rory in Barbados years ago. This Burger King tried to get into Barbados about 15 years ago, and when they first came, there was resistance from locals that said this is unfair competition. So strangely enough, Chafet got together with a whole set of the little small, which I find were totally different niches, different areas. But you imagine Chafet going to small shops all in Baxter Road and little small shops that selling fried chicken. And Chafet was able to get them to support them in going to government to argue that the government needs to not support the application for Burger King to set up business in Barbados. And the government actually rejected it. I think the second time around they tried it, but the government of the day said no. Right? But you imagine me little small shops, just a one shop. The fellow would open weekends, Friday, Saturday, Sunday. Chafet was able to convince, you remember that time, yeah? Chafet was able to convince them that it is in your interest to support us, that this thing is, but the first thing, the people who will go to those small shops in Boxers Road, Lisa and Tanya, ain't going to Chafet, you understand? There's a particular group, you understand? So when they saw, I said, but they're different clientele, the Chafet attracts a different clientele. But people who were going Boxers Road with the little small shop open Friday, Saturday, Sunday, go and drink some rum, some vodka, and you buy some fried chicken, just fry out. So, standard quality. If you go this Friday, it is one thing. The next Friday, the quality change, depending on which cook on duty. So Chafet was a totally different package. But again, as they said, they were able to have this legal framework to put the entry barriers for Burger King at that time. The offensive, mergers, hostile takeovers, acquisitions, and price wars, right? So the merger is two companies agree, let's come together and create a new company. A hostile takeover will happen where will hostile takeovers happen? Where will hostile takeovers happen? What business context? There's a particular business context in which it can only happen. Anybody get it? What is a hostile takeover? Right, I don't think it happens in the Caribbean a lot.
You force a company to basically almost go bankrupt and then offer to buy them up.
Well, I would say offer. I would say offer. I would put it this way: is that it has to be a publicly traded company. So what happens? Stocks are being sold on the open market. So what wealthy people could do, you get your stockbrokers to identify people who want to sell, and you agree to buy these shares at a particular price. So you get people to sell, and people are selling, and you paying them a premium price, and you're selling, and eventually, if somebody doesn't monitor, if the owner, if the people who have the majority shares don't monitor it, it could come a point where so many people sell their shares. In fact, that's what happened with Sagicor when they were switching over. That people just sold their shares because with a mutual company, so a lot of people, thousands of people own shares. So what they did, they just, in fact, um, the Trinidad power brokers did that because Trinidad actually has the majority shares in Sagicor now. So what they did, they just started buying shares and buying shares and buying shares and encouraging people to sell. And when people got a premium offer, they take it till they got control. So that's why we talk about it going to Trinidad and the chairmanship changing because Trinidad in a way bought up the majority shares and took over. You know, according to the articles of incorporation, it will determine what percentage of the person or group that owns a single block of shares would be able to take over chairmanship. So what happens in the stock exchanges overseas, you know, very powerful people could actually target a company and buy up the majority shares, take over the board, and probably see it on TV sometimes, and it's real life. So somebody comes in and say, "Oh, folks, effective from today, I now own 51% of shares, and I am moving that a new chairman be appointed." And if the company's in article incorporation state clearly that the person with the majority shares can take over chairmanship, you've lost control of your company. And a lot of people lose control of companies just like that. So when you're on the public stock exchange, I mean, we are not aggressive here, but think about the U.S. stock exchanges. I mean, the kind of way shares are selling, something happens and shares just sell. So people from any part of the world and the country just buying shares, buying shares, buying shares. So so that's what the hostile takeover would be. The previous persons who led it, in fact, the body who formed the business, who owned the majority shares and put it on the market, might just have to sit by and watch somebody else take over their company.
This guy has been trying to take over Arsenal for years.
Yeah.
Russian billionaire.
Yeah.
And has convinced many to sell out shares, but can't get the majority.
The majority, right? Yeah. So most likely, what is happening, the people who control Arsenal might be doing their own aggressive marketing and PR, encouraging members not to sell. So you see, because if you're not that mindful and you don't monitor trading on the stock exchange, you could lose the control of your company and not even know you lost control of it. You see, because people that willfully wants to see something that's valuable and it's on the stock markets and it's a publicly traded company, your game, especially if you're profitable and you have a really good product. You see. And price wars, something that people do to knock people out. So huge companies can get into price wars, drop the price right down to kill competition. But you have to be very powerful. $1 billion companies do it. They set up a price war, and who can sustain these low prices for the next 10 to 12 months? You have to have a very strong asset cash base and asset base to do it. So acquisitions, you take over somebody, which is one of the major strategies. So what I want you to do now, we'll go till 7. I want you to, if you want to do it together as a group or individually, but I want you to, based on the strategies we went through, identify you can put like a column, Digicel, flow, and then identify which of these strategies do you think flow is likely to be using currently or used in past. And when you think about flow, which of these strategies do you think flow might have used in past or is using now? Right, so it's a very practical real life case scenario. And then we will come and have a discussion then of open discussion of what you have identified as some of the key corporate or competitive strategies. Well, this thing is not Yes? Wow. So if you want to go on the web and just do a search to find out, in fact, looking at the advertising, looking at how they advertise, you know, sometimes they send us messages on the phone. So look at the little strategies, how they advertise, what images they use. That can give you an idea of how they approach their competitive strategies. Go to the washroom.